right, howdy, and welcome to the UrbanGate investor presentation for Fund One. How's it going, guys?
Doing great. How are you, Will?
Doing awesome.
Doing excellent.
Glad to hear it. Well, we just wanted to put together a quick presentation about the fund that we're launching. Basically, we're launching a debt fund in Middle Tennessee where we raise capital from investors and we lend that to people who are flipping houses mostly, and just kind of wanted to put a presentation together to give you the nuts and bolts. So let's get into it. So before we get into the details, I did want to do an intro of each of our partners here. We've got a lot of experience here on the presentation, much more coming from the other two than myself, but Brian, I'll let you kick us off. I'm going to tell us a little bit about yourself and what you do at UrbanGate.
Awesome. Thanks, Will. My name is Brandon Thornberry. I live in Nashville, Tennessee. I'm a husband, father of 3 kids. When I'm not hanging out with the fam, I'm most of the time investing in real estate. And I started out investing in single family in Nashville 17 years ago. Nowadays, I mostly invest in apartment buildings and commercial buildings. And a couple of years ago, I started noticing that in between my deals, I had money sitting around not doing anything. And so I started doing some hard money loans on the side to put that capital to use when I wasn't under contract for a deal. And I quickly realized that I had more loan opportunities than I did funding. And so that's when Will came along and he really poured gasoline on this fire, and the lending has just exploded over the last year or so. So we're excited to talk about this. This fund is really an opportunity for you to fund great deals, earn a great return, and do it all passively. So that's a little bit about myself and how we kind of got to this place. And Will, let's hear a little bit about you.
I appreciate that, Brandon. And for those of you who are listening, Brandon's kind of role at UrbanGate is our chief credit officer. So Brandon has a ton of experience, looking at deals, purchasing deals, operating deals, specifically here in Nashville. So all of the lending decisions go to Brandon, and he's been, irreplaceable in terms of like knowing things like zoning, street names, all the city ordinances and things like that. His knowledge has really made sure we're making good loans. So we appreciate you, Brandon. And so a little bit myself, I am the CEO of UrbanGate Capital. And really my responsibility is the operations and the investor relations. I started purchasing real estate in 2016, mostly small single family in Texas. At the same time, I was working as a credit analyst for a commercial real estate bank in Texas. So my responsibilities were putting together 20 to 30 page packages for commercial loans that were being made mostly in North Texas. And then after that, I worked as a director of finance at Rand Capital. We were a commercial mortgage brokerage that helped people source debt on multifamily. And that's actually how I met both Brandon and Logan, was trying to source some business from them. So yeah, I've been kind of in the debt world my entire life. I have a strange love affair for debt and real estate. So it's a perfect combination. And I'll pass it over. So every team needs a superstar. And I would say Logan is our superstar. So I'll let him tell you all about himself.
I appreciate it, Will. Logan Rankin, and I'm out of Wisconsin. So the Green Bay, Wisconsin area. So huge Packer fan. I have 2 little kids as well too, so I enjoy coaching them in all sorts of different sports right now. One is 7 and one just turned 5, so that's a lot of fun. A little bit of background on my experience is I spent a decade for a Fortune 50 company. Did a lot of different roles for them. 2 of the last roles that I did with them, one was a vice president where I oversaw 5 different states and $3.5 billion worth of sales and 19,000 people. So really got to learn a lot about, hiring the right people, growing a large team, as well as managing a big P&L. So a lot of leadership stuff. And then my last job was how to effectively ensure there's efficiency throughout operations and systems, but through people across the entire enterprise. So mostly focused across the United States on getting 360,000 people to do their jobs more efficiently and help scale that. So that translated a lot of those skills into real estate. So in the last 3 years, I've grown 3 multi-million-dollar businesses. The biggest one would be my holdings portfolio, which in about a month will be 2,500 units. My wife and I actually own 100% of that equity still. So we've been able to scale by building a really big property management company to be able to manage that as well as my employees' properties. So I love business strategy. I love scaling. And you have to obviously utilize debt very strategically to be able to grow like that while retaining the equity, which is why when I heard Will and Brandon were building this fund, I wanted to be part of it because I know I can add a lot from a business strategy standpoint, but also just from an overall scaling standpoint. So I'm really excited to join these two to build an incredible fund. And I think that you guys will learn as we page through this presentation what a credible opportunity that this fund is and how hard we're going to work, the 3 of us, to make sure that this incredible opportunity continues to scale too.
Yeah, appreciate that, Logan. It's funny. I think we bonded originally a few years ago just chatting about debt and interest rates. So it's kind of fun to see that come full circle. So sweet. Let's hop into it. All right. So I'm going to move this again like this. All right. So this is kind of the meat of the presentation. Why invest in hard money loans in Middle Tennessee? And I really like to think about this in terms of, I think we're kind of in an economic environment where it's useful and it's rewarding to put your capital into a low risk type investment. Not all of your capital, but a portion of your capital needs to be put in a position to where the worst case, you're still in a pretty good spot. So another way to think about this is putting your capital in a good risk or a healthy risk adjusted return type investment. And with hard money loans, we feel that this is a very healthy risk adjusted return, especially with it being in Middle Tennessee. And a good question to ask yourself, if you know that you're kind of checking that box of a healthy risk adjusted return, is what happens in the worst case scenario. So what happens to my capital in the worst possible scenario? And so for that, I'll hand it over to Brandon to touch on kind of this first point of preservation of capital.
Yeah, that's good stuff, Will. I really want to touch on, before we get into return on your capital, talk about return of your capital. And so when I'm talking about that, I'm thinking about, how safe is your investment? And so one of the things we love about these deals is that we're in first lien position. And so up to date, we've had a 0 default rate, but if a deal would happen to go south, we basically have a foreclosure attorney sitting on go, and we can get a foreclosure done in 60 days. And so if that worst case scenario would happen to happen, we would either quickly sell the property in as is condition, or B, we'd renovate and sell the property. And by the way, I've done over 100 flips in the Nashville area, so we have the resources to make that happen, and we would oversee that entire process. Or C, absolute worst case, we'd keep the property in our portfolio as a rental property. So I love deals where there's multiple exits, and fortunately, we've never had to foreclose on a property, but if we did, we would be in that first lien position, and then we'd have multiple ways to exit that deal and keep your capital safe.
Awesome. And could you touch on the loan to value? Because I think you had a realization after talking to a few other lenders and seeing kind of their loan positions in reference to ours that made you feel even more comfortable. So could you touch on that?
Yeah, so I have seen some some other lenders being pretty aggressive. I like to think we're very conservative. So there are a lot of deals that we pass on because we don't like the LTV or the loan to value position. We're always asking ourselves, would we want to own this at the price they're paying, or would we want to own this deal at the loan position we have? And if the answer is no, then we pass on it. So we like to stay at 75% or lower on the LTV.
Absolutely. And in this environment where you want to prioritize preservation of capital with a percentage of your capital with your portfolio, you still need to make money with your capital. You don't want to put it in bonds that are, losing money on a real return basis, or just put it in cash because that's losing to inflation. You still want to have a strong yield. And I think Logan is one of the best people in the world at like identifying ways to velocitize your money. So Logan, could you touch on this second piece?
I'd love to. Yeah, I literally obsess over this. So I think a lot of people, here's the facts, right? A lot of people look and work really, really hard for their money. But I think a lot of people don't quite understand how to make their money work for you. So one of the biggest reasons I'm so excited about this fund is because we wanted to create an opportunity for people to not just work hard for money, but put their money to work. And I think before I even get into like a lot of the advantages of putting your money to work through this, we just talked about like the risk, right? I think a lot of times we're talked about that you need to have high risk to get high reward. Well, we're working really hard to build a fund that's low risk and very strong reward, right?
Mm-hmm.
I think we understand out there right now that you have to put your money to work, otherwise it's going to get taken by inflation. That's a real risk if you do nothing. But then there's also the risk of, putting your money into something that you can't control, which we're going to talk about later. A lot of people that put their money into a 401k, for example, or to stocks, it's really, really hard to control those returns and to control your money. And by the way, if you're in any traditional environment right now and you're not down 20%, you're probably doing well. It's just a lack of control. Where this talks about, we're going to give a consistent high yield. We're going to deliver 8%. And we're not just delivering 8% yields on your money, by the way, which is a significant hedge against inflation. We're doing it what a lot of funds don't do. We're going to deliver it in monthly cash flow. I mean, I just wrote a book on this because you cannot put your money and say you're getting 8% returns if the money is not actually in your bank account. This is a really, really strong advantage of our fund, because if you look at a lot of funds, they'll hold on to your money and they'll say they're giving you 6% usually, maybe a little bit more, but they won't give it to you for 12 months, right? Or they won't give it to you for an extended period of time. But to fight and hedge inflation, and certainly to hedge the uncertainty and the ambiguity in the market right now, you want those returns right now so you can reallocate that money how you see fit. You do not want that locked up. So the monthly cash flow is a huge opportunity to keep your money working, and also to give you the control over reallocation of that money too. And then this is one of the coolest part of this fund. A lot of funds lock your money up for a year, right? That's a little bit better than getting locked up your money in a 401k until you're 59 and a half. We give a 90-day liquidity option. So if you can find a better use for your money, right? If you can find a better use and you can get a higher yield than 8% month after month with a lower risk, right? We allow you to be able to pull that money. So again, giving you the control. We feel so confident that the product that we're offering you, that you're going to want to keep it with us, and that it's going to be very hard to find an adjusted risk return better than ours, that we're actually allowing you to be able to pull that money from us. We just 90 days to be able to reallocate that, which a lot of funds don't do. And again, it's because we wanted to provide a product where we're giving control over your money, and that we're really confident you're going to end up keeping it with us. And if we're wrong and you find a better rate of return on your money, then we're happy for you. We'll give you your money out, be able to reinvest that wherever you want, and we'll be here if you want to be able to put it back in. So I think a lot of people think of, like, we just talked about risk versus reward. Here's the last thing that I just want to touch on. When you want your money to work hard for you, you don't want to be working. So the one thing I try to think about now in my career is time versus reward.
Yep.
I think that's a really, really big advantage, because I constantly am hearing a lot of real estate investors, right, say, I got passive income. Well, if you own properties, right? I don't care if you own the property management company, you have a third-party management company, there's still work involved. Okay. This is a really good opportunity to have very limited time. You send a wire, for goodness sakes. to take your chunk of capital and let us put it into real estate so that your money is still in real estate, but with none of the work. And what's really cool about a fund with making your money work for you, we're not just putting it in one property. We're putting in a lot of property that the three of us with a substantial amount of experience have vetted, as you heard Brandon said, that we would buy ourselves. So we're putting it across a lot of different properties. So even though we've never defaulted on a loan, your risk is spread across a ton of different properties. And on top of that, if you would have the default, you're still getting that 8% because we're figuring out how to foreclose and how to make even more money on that property if somebody wouldn't return that capital. So this is an awesome opportunity, guys, to make your money work hard. And we're really excited to bring that to you.
Absolutely. Yeah, I think I was talking to a few other debt funds that kind of do similar things, and we're talking terms, and they're like, man, you guys are nice. and a big part of it is, I think most of them had a 2-year lockup period, or you didn't have the ability to withdraw within 24 months, within the first 24 months. So we're definitely excited to offer this to you guys. I'm a big believer in each person on both sides of the transaction should be equally excited, and I hope that we're providing that here. So the having your money work for you, your preservation of capital is really, really important. I think the diversity that Logan touched on is also really important. And something we haven't touched on that is maybe the most important piece is the location of where we're making our loans. So you hear it all the time in real estate, location is important. Location. I was trying not to say it, but I had to say it. So I've lived here in Tennessee for just over 2 years now, and I've been in Nashville for just about a year. Brandon's been here much longer than I have, but the growth and the amount of people and the life of the city is incredible. I think it's one of the best markets to be in terms of supply and demand ratio that potentially in the country, from a people moving south, people wanting to live in kind of a fun city. It just has all the pieces. And to put some numbers to it, so population of 690,000, 12.84% growth since 2010, grown. Tennessee overall as a state grew 8% in the last 10 years. And I am quoting Brandon on this one, so I don't know the source on this one, but we're estimating 50 to 80 people per day are moving to Nashville. Brandon, would you know the source list by chance?
I don't have that article in front of me, but it's substantial. Yeah.
Yeah, no worries. But I figured I'd throw you that ballpark. But a great way to think about that is, okay, if 80 people, let's say it's 50 people to be conservative, moving per day, times that by 100 days, that's what, 5,000 people that are moving every 100 days to Nashville. Or no, I'm not great at mental math, but the amount of people moving per day every 100 days, and then ask yourself, is that many houses being built in the same amount of time? And I think that's a really good way to think about the growth and then the supply and demand ratio. So there is not enough housing for the amount of people moving to Nashville. And a good metaphor or like way I like to explain it to people is when I go to a bar, or I go to a restaurant, I'd say 50% of the people I talk to just moved to Nashville. And I bet Brandon has had a similar experience. So they're like, oh yeah, I just moved here.
When you meet somebody in Nashville, you say, where are you from?
Right.
It's not a normal thing you ask people, because in Nashville, nobody's from here. If you meet somebody from Nashville, they're a unicorn. So most people you meet are not from here. They have moved to Nashville.
Yeah,
so,
yeah, it's quite rare. So you've got the amount of people moving to Nashville. You've got Oracle, who is building a headquarters in East Nashville, very close to where a lot of our lending is. And then you have really strong surrounding areas. So you've got Murfreesboro, which is just around here, Clarksville, which we love, Fort Campbell, which is an Army base, Columbia, Tennessee, Franklin, Chattanooga, which is down here. Like we love these markets, and the growth is just insane. Brandon, I know you own multiple properties in a lot of these areas. I just want to touch on kind of the growth and the strength of these markets you've seen.
Yeah, I mean, so I have complexes in Clarksville, Columbia, and Chattanooga. We were just talking about Columbia today. We literally have raised rents on a complex we bought last year from $775 a month to $1450 a month. So that is just off the charts rent growth. There's just not enough housing. So we continue to feel like Middle Tennessee and Nashville especially will be somewhat isolated if we do have, some recession and market adjustment, mainly because of just how many jobs are coming here between Oracle, Amazon, and some of other big companies that are moving facilities here. And these Oracle jobs, these are not warehouse jobs. These are $200,000 a year salary jobs that are going to be coming to Nashville. So these people are going to need to buy houses. So we feel strong about Nashville and Middle Tennessee moving forward.
Absolutely. And so the combination of first lien, high yields, the location, and it being, short term with the liquidity option, we think it's a very healthy risk adjusted return to place your capital. So let's keep chugging. All right. So we know why we like to make these loans. A question we get asked often is, what type of properties are we lending on? Who are we lending to? What is the loan product? So we really have three main loan products that we lend on. The first one is a single family flip. So a borrower is purchasing a property for $200,000. They're going to put $30,000 worth of work into it, and then they're going to sell it for $300,000. They would use our capital to purchase the property, and they would use their funds to do the renovation, and then they would sell it. So that's 90% of what we do is a single family fix and flip loan. So I kind of alluded to it. We lend up to 100% of the purchase price. We limit it to 75% of the value of the home after the renovations. We do not lend on rehab funds. We may do it on a select deals, but so far we haven't done any, and we generally don't. And then our loans are anywhere from 1 to 6 months. And in fact, right now, our average loan term is about 72 days. So that's the bulk of what we're doing. We like to stay around Nashville and the markets we know really well. And yeah, that's the majority of loans we make. The two others that are still pretty common would be a land acquisition loan. So that is if, let's say a borrower wants to build a house and they want to go purchase a land or a piece of property in order to build on it, they'll use our capital to purchase the property, and then they'll go to a bank to get a construction loan. So they'll hold that piece of property for 30 to 90 days with our capital while they're going to get the construction loan. And our loan allows them to close in 1 to 2 weeks with cash, and it makes it lucrative. It makes their offer more appealing. And we love these loans because typically we can call the bank and say, hey, have you looked at this property? How do you feel about it? And they say, oh yeah, it's already gone through underwriting. Like, we feel great about it. And we go, okay, perfect. And we'll go lend on it. So with that, you can kind of see the terms we like to be. We like our loan to be at 25% of the value of the home. So if it's $1 million home, we like our loan to be about $250,000 or less. We don't do any rehab or construction, and then our terms are the same of 1 to 6 months. And then lastly is the transactional loan. So I'll move this guy out of the way a little bit. So the transactional loan is typically for wholesalers who are purchasing a property at the beginning of the day and then selling it at the end of the day. So it's same day funding, and they just need our capital for 24 to 48 hours. The reason for this is if a wholesaler is purchasing a property and they don't want to disclose the amount they're going to make, they will purchase it. So let's say they're purchasing it $100,000. and they're going to sell it to another buyer at 150,000 the same day. They don't want to disclose they're making 50 grand. So they'll purchase it with our funds in the morning and then sell it on the back end for 150,000. And we'll send our capital title and we'll get it plus the interest and profits the same day. We love this stuff. We'd do one a day if we could, because we can protect ourselves from the contract point and the title company, that really our funds don't go out unless we're 100% sure they're coming back to us. So it's a great loan for us. Brandon, any feedback or thoughts on these loan types?
No, I think you did a great job. I mean, we love those deals where we know the bank, and we're even starting to get banks calling us and saying, hey, we've got a deal, we love it, we can't get in closed in time, could you guys fund it? Like, well, if you love the deal, I mean, absolutely. So those are some of our favorite loans in addition to those same day loans, and we're trying to ramp that up more and more.
Absolutely. And so when it comes to underwriting, I think of it as kind of three frameworks. So you have your borrower, your property, and your exit plan. So the borrower, we like to look at their credit. We like to look at their liquidity statements. We like to look at their experience. I like to go meet them in person and grab coffee with them. And if it's a borrower, which most of our borrowers are people that send us 2 to 4 loans a month. And so we've already built a relationship with them. Brandon may have known them for a number of years, and we have kind of established trust with them. But we really put a lot of emphasis on the borrower and the relationship and say, what kind of borrower is this? Is this someone you trust, et cetera? The second is the property. So the location, what year is it? What's the purchase price? What's the loan to value? What's the, is this a property we would want to buy? Like getting really dialed in on the property. And then lastly is the exit plan. So if they're going to sell it, what's their ARV? How much profit are they going to make? What are the comps? If they're going to refinance it, okay, what bank are they working with? Have they worked with this bank before? What's their loan going to be in ratio to the appraised value? Is that enough to pay us off? So really kind of focusing on these three frameworks and making sure each of those are checked off makes us feel very secure about the loan. And this underwriting kind of 3-step framework, I specifically have taken with me from Citibank. And this is the exact same thing they would do with their commercial lending. So I've used it for my entire career. So that's good. And then we've alluded to this a couple times, but this is a question that I personally love. And I think Brandon likes to push back on a little bit because he wants to be a little aggressive sometimes. But, if we're not sure about a deal, and this does happen pretty often, if we're like, hey, we like it, we think it'll be good, but we're not sure. We'll say, okay, would we want to buy this property at the loan amount we're making? Yes or no? Like it's pretty black and white. And that really helps us make a decision in moments we're not sure. And, oftentimes the answer is no, and we pass on it specifically because of that. Logan, you've been a buyer of many properties. Can you talk about how this question gives you comfort in terms of analyzing risk?
Yeah, I can. So, I mean, at the end of the day, I think one of the biggest things that you already answered is anybody that's going to give money to this fund, you're going to look at 2 things: the structure that we've hopefully continued to share with you so far, but also us, right? Like when I give money when I decide to buy a deal, or when I give money and do my own hard money lending, like maybe many of you guys, it's first the person that you're giving the money to that matters. So you're giving the money to us first. And we want you to know that the thing that I look at is then who are we in turn giving the money to? So that's why on the bottom, you see good properties, great location, first class borrowers, is because the person that's actually taking our money, we want to feel the most comfortable with. And it's not rocket science. Like it's actually pretty easy. If they're a great person to work with, a good person, and we trust them enough where not only would we buy the deal, but like we trust the person or the individual we're giving the money to, then that goes such a long ways, because it's that individual that maybe bought a good property, but something happened, but we're going to count on them to be able to figure it out. It's probably why we have a 0% default rate so far as well too, because we put as much time into the individual as we do into the property itself.
Absolutely. And me and Brandon were just having a discussion recently of it, it was good property, great location, but it didn't quite check the last first class borrower metric. And we decided to pass because of that. So even though that was a loan that we could have foreclosed on, worst case scenario, and we would have been okay, it didn't quite meet our standards. And so we moved on because of it. Sweet. Anything to add there, Brandon?
No, that's all perfect.
Awesome.
100%.
Okay, so let's see if I can move this a little bit better. So these are the fund terms. So we'll go through them quickly. It's a lot of numbers and a lot of words, so I won't bore you guys too much, but I'm sure investors are interested to know this. So the fund term, it's evergreen, meaning this fund is going to continue until we decide to either pivot or change the structure, meaning it's not a 3-5 year term. Obviously with the structure of this, the investor is able to withdraw capital. So you're kind of in it for as long as you would like to be in it. We're paying an 8% monthly distribution. You can see down here at the bottom, if you invest $100,000, which would be our minimum, it's about $667 per month. And then if you invest $250,000, $1,667. This is what an 8% monthly return would look like. It's 8% annually and then divided up monthly. You've got a 90-day redemption notification, basically meaning if you would like to withdraw your capital, you are able to. We just require a 90-day notice. And to provide a little peek behind the curtain of how we provide this liquidity option is, first would be, our average loan is 71 days at this point. So if you request your capital back, there's a good chance that within 90 days, we'll have a number of loans pay off and we can use that to return your capital. The second would be, as a fund, we're constantly going to be raising capital. So a portion of that could be capital we raise to pay off the investor. And then the third is we ourselves are able to temporarily fund the gap with our personal funds. So that's kind of our 3 routes to return the capital if needed. And then minimum investment is $100,000. And this is a 506C offering, meaning that we're only able to accept accredited investors. If you have questions on the definition of accredited investor, let me know. But basically, I believe it's a net worth of $1 million, not including your single family residence. And then if you're single, it's a consistent income of $200,000, married $300,000. But I'm happy to send any definitions as needed. And then a few things to note. So I'll move this over here. The first $1 million to commit to the fund will receive a 9% return on their capital committed for the life of that money that sits in the fund. So if you invest $100,000 and you're one of the first $1 million to commit, if you leave that $100,000 in for 2 years, that capital would earn 9% for the life of it being in the fund. And then for the first 8 months of the fund, so meaning July and forward, we are going to hold the distributions for the fund for the first 8 months. This is simply because it's our first time launching a fund, and we want to make sure that we have the operations and the cash flow and everything set as we're kind of get going. And those returns will accrue. So on month 9, you'll receive all of the returns from the first 8 months, and then as well as the interest for month 9, and then moving forward, it'll be monthly after that. So I know that can be confusing. If you have questions, just let me know. And then a point that's important to note is if you invest after the 8 months, the first 8 months of the fund, you you'll immediately start receiving the distribution. So if you invest in month 10, you'll immediately start receiving those monthly distributions. We will have a 6-month hold period that we ask you to keep the funds in with the first 6 months. And there's a soft lockup period up to 24 months, meaning that there'll be some withdrawal fees if you do within the first 24 months, but within the first 6 months, we're gonna have to hold it. And then we are not charging a management fee. So I think this is rare for funds to not charge a management fee. And with this being our first fund, we really wanted it to be as simple as possible for the investors. So you invest 100,000, there's no fees involved, there's no management fee. We make all our money based off the operations and the performance of the fund, i.e. we don't get paid at all until you as the investor get paid. So I think that's really important. And we went back, it depended on the day, we went back and forth on this, and we ultimately decided to go with what was favorable for the investors. Logan, any thoughts or points to bring up on this?
No, I think the last point's the biggest one. Everything else is pretty standard, other than I think our fund, the monthly distributions is different than most funds. I think we're giving a higher rate of return. I think the liquidity thing we covered in general, it's very nice. But yeah, we don't make money unless you make money. So your job is to give us your money and not spend any time. Our job is to work our asses off to put that money to work in safe investments. And that's the only way we get paid as well. So I think that the cool thing is we're making this as simple and easy as possible. And we're not taking any management fee to do it.
Perfect. Brandon, any thoughts there?
I love it. No, you guys summed it up great.
Perfect. Sweet. So the next steps really are so right now the first million to commit will receive the higher 9%. We've already received commitments for about $500,000. So that is closing up quickly. So even my parents were texting me about it. So if you would like to commit and earn the higher return of 9%, email me at will@urbangatecapital.com. I will email you the legal documents to review, and you'll be considered locked in basically once we get those legal documents signed. And then additionally, all of us are pretty active on social media. So if you want to learn more about, we each kind of do individual things as well. So I'm most active on Twitter. Brandon is most active on Facebook. And then Logan is on Instagram at Logan J. Rankin. So give us all a follow. And yeah, check us out. Shoot me an email if you have an interest or questions. And then lastly, we can't leave without a fun legal disclaimer. So again, I'd recommend pausing this and reading through it if you have questions. If your first thought is, wow, this is long, just remember it is, and that's because we have a good attorney. But basically, this is a 506c offering. Everything in this presentation is, it's estimates and pro formas and not guaranteed. And again, recommend you reading it if you have questions. So any closing thoughts, guys?
The only closing thought I said were, if you decide to trust us with your money, I just wanted to let you know that Will, Brandon, and I take that very seriously. When I started investing in hard money loans, it was less about the deal itself and it was about the people that I was giving my money to. And that is why we share our social media stuff with you. We're not afraid to tell you who we are and what we've done and the experiences that we have, because we want you to trust us, and we're going to work really, really hard to prove that your money's in great hands and that we have an incredible product to be able to give you really, really strong adjusted rate returns that I think you will enjoy for a long time. So we're excited to work hard for you. And if you have any additional questions, obviously you have Will's email, but don't hesitate to hit Brandon and I up as well.
Absolutely. Yeah. And thanks for putting this together, Will. Great job. And if anyone wants to reach out to me directly, please do.
Awesome. Thanks, guys, and look forward to hearing from you.